Hi there. Okay, what is going to happen to your home value? We're getting a lot of calls and we're going to talk about that today. And you are our clients, whether we last spoke 20 minutes ago or 20 years ago. We care deeply about you and your real estate investments that you entrusted us with. So first, there's a lot of crying and yelling and general gnashing of teeth over the current changes in the real estate market. And I'm going to try to break this down so that you can see exactly what I see. Now, there are a lot of people talking about how real estate values are about to crash. But are they now? This is going to take a minute to explain, so stay with me here if you can. First, you may or may not know that I began my real estate career in the 1980s, if you can believe that. So I have been around a while. I've been through 5 market shifts and 1 bubble or crash in my career. So I know what I am looking for right now, and I'm watching the market very closely. So let's also clear up some confusion. We're talking about 2 subjects that I see even some experts blending. One is a market shift to a buyer's market, and the other is a market bubble or a crash in values. These 2 events are not the same thing. Just to make sure we're all on the same page, a buyer's market or a seller's market simply means that the current market favors one over the other. Now, due to buyer demand and a shortage of homes on the market, I'm not going to say a year because I don't have that fact, but for the last several years, we have been in a clear seller's market, and that is definitely changing. And in my opinion, it needs to change for stability. But are we going to crash? Now, I'm about to tell you what I know, not what I heard, so stay with me. And by the way, my information is from a nationally reliable source, such as Keeping Current Matters and others, which gather the most accurate data regarding real estate. And these are real numbers I'm giving you. So historically, the real estate market shifts back and forth from a seller's market to a buyer's market about every 8 to 12 years. And these shifts have been precipitated by a recession. Now watch, this is where it gets interesting. In the last 6 recessions since the 1980s, homes have actually gained value in 4 of 6 recessions. 4 recessions, homes gained value. In 1980 and 81, we had a recession fueled by an energy crisis. Okay. We gained in those 2 years almost 10% appreciation right in the middle of a recession. 10 years later, in 1991, we had another recession, again related to oil. 1991 was the first time since keeping records that homes actually lost value, but it was a modest 1.9%. It felt worse here in Oakland County, Michigan, because we trend about 6% appreciation a year. When you lose 1.9% of value, that's a 7.9% spread. And then, much like now, news reports of the housing industry were alarming. We all thought we were going to lose our businesses and half our value. It was terrible. But when the dust settled in that recession, the actual loss of a home's value was about 1.9%. Now, 10 years later, in 2001, right on schedule, we had another recession. And this time, it was the dot-com bubble. And this recession was due to crazy speculation of tech and internet stocks. And then for a reason I don't understand, like the stock market just plummeted. And a lot of people lost fortunes. Retirements were threatened and large companies just went out of business. It was a really hard time for a lot of people. And yet home values rose an average of 6.6% nationally. And fast forward to 2007 came the Great Recession. This is when all hell broke loose for real estate nationally. Life ceased to exist as we real estate agents knew it. And frankly, I wondered if and how we were going to survive it. It hit the real estate industry and homeowners hard. But there were contributing factors to that mess, which, if you want to see an entertaining account of it, watch the movie The Big Short for an explanation. It's pretty accurate. Plus, it stars Ryan Gosling and Brad Pitt and Steve Carell, but I digress. Anyway, back in 2007, real estate was a complete rodeo. Lenders were giving loans on stated income. Like, how much money do you make annually, Bill? 800,000? Oh, great. Sure, you qualify for that $1 million jumbo loan. Zero documentation to support the stated income. Everybody could get a loan if you had a decent credit score, and some if you didn't. Many appraisers were right in the lender's office working for them. Dishonest appraisers were colluding with lenders to overinflate home values for financial gain. Homeowners were silly and tapping their equity to fund lavish lifestyles that they couldn't otherwise afford. It was a mess. But prices kept expanding and expanding until you guessed it. The bubble burst and home values crashed. And by the time we hit the bottom around 2010, the average loss of a home's value nationally was 19.7%. I can tell you here in my personal business in Oakland County, it was closer to 30. It was unprecedented and it was tragic for you, our clients. Short sales and foreclosures dominated our market. That was a real estate bubble, accompanied by a shift to a buyer's market. And it lasted about 5 years until we began recovering in 11 and 12. The Great Recession was a boon for real estate investors, though. But things are vastly different now than they were in 2007. Congress has enacted laws that brought sweeping changes to the entire industry. There are new rules to prevent collusion by appraisers and lenders, third-party appraisal reviews to prevent dishonest overinflation of values, and new rules regarding the transparency of fees charged to a buyer by a lender to close a loan. There's also much tighter lending guidelines as well. And if you happen to be self-employed, like we are self-employed, and you try to get a mortgage today, then you know exactly what I mean. It's much more difficult. You have to document your income multiple ways, multiple times throughout your transaction. So here we are in 2022, and historically, we are right on target for another recession. And I think we can all agree it just might be here with gas at $6 a gallon. But here's the thing. Compared to 2007, I don't see any of the same indicators of a housing bubble that I saw back in 2007. The fact is, home prices increase and decrease based on demand, and the law of supply and demand rule here. There are fewer homes available for purchase now than there were in 2008, yet we have our millennials of home buying age making demand much greater than in 2008. So unless something drastic happens that we can't foresee, I think home values are going to continue to be stable and they're going to gain in value. What we have is a very dramatic shift from a seller's market to a buyer's market, created in part by the Fed strategically raising interest rates to control inflation. Now, it would take a day-long class to learn how inflation affects the housing market, and I'm no economist, but there are a lot of resources around to teach us how those two are interconnected. So like me, continue to educate yourself there. But my message is this: let's calm down. This is nothing like the real estate market of 2007 and 8. I was there, I lived it, and I survived it. So here's the truth. Roger and I were both 22 years old when we bought our first house, which is ridiculous when you think about it. But do you know what the interest rate was? 12.5%. We refinanced that house a couple of years later when the rates dropped. We sold it for a nice profit a couple of years after that, and we moved up to a bigger house that we could afford. And that's how it works. That's how it has always worked. And so you know when you should buy a home? When you need one. This current interest rates will change how much home you can buy. I can buy for sure, but that's a lifestyle shift we can all make for a basic need like shelter and a proven long-term investment in our future. Can we live in a home that's a bit smaller than we anticipated? Can we stop unnecessarily remodeling our homes like it's a spring fashion season? Maybe we can curb some personal spending and learn to live more frugally. I think we can. And it's a bit scary out there right now for sure. I am not downplaying it, but I've been here many times before. And my advice is to step away from the noise and the chaos on social media. Take a realistic look at your financial situation, and we can help you do that. Take a walk, take a knee, take a breath. Most of us are going to have to make adjustments coming soon in lots of areas. But unless something drastic and unforeseen happens in the future, I think we're going to safely navigate this one too. Homes will still sell and buyers will still buy. I think we're going to be okay. I'm Gwen Daubenmeier with the Integrity Team, and if you have questions or need help learning how to adjust your spending, we're here for you. Thanks for being part of the Integrity Team. You belong here.